The last thing I wanted to talk about was trading, because unless you never sell anything, the story is not over when you bought the stock. And you have your position size. Like, very few people are going to buy something and then never sell it and have that be the right decision. If you bought Berkshire Hathaway in the 60s, that's one of the few. If you bought a lot of other companies in the 60s, it was a bad idea if you never sold. So my broad piece of advice when it comes to trading and thinking about the market is don't look at your portfolio too much. The way I deal with this is that I do not look at the value of my portfolio or the stock prices of anything that I own until Friday evening after the market is closed. I do this for a couple reasons. I don't think that I get actionable information from looking at the market. I think it's a distraction, if anything. The way that our brains accept gains and losses are that losses hurt twice as much as gains. So if your portfolio is up 3 days out of 5, you will feel bad. So the more you're looking at the value of your portfolio, the more it is likely to hurt you. And I don't think that that hurt will enable you to think any better. I also think that as humans, we think better when we're hunting than when we are trying to protect ourselves from danger. And the more you look at your portfolio, the more you'll want to protect it from the evil market. Whereas if you're not looking at it and you're looking at things to hunt and kill, you will be excited by the market doing things. So that's my one broad piece of advice on trading and dealing with the market with your portfolio. Some people are forced to look at the value of their portfolio all the time, and God bless them. It makes the market less efficient, and I can benefit from you guys. I'm sorry. I'm sorry you're forced to deal with that, but that's the way it is. When it comes to stocks and stock price movements, there are two things that have academic research behind them showing that they succeed. One is value investing. Buying stuff cheap works. It works statistically. You can see it. There's evidence out there of it. The other thing that works is momentum, where a stock price rising keeps rising, a stock price falling keeps falling, and that works. These two are incompatible. So momentum tells you if a stock is going up, you buy it or you don't sell it. Value investing tells you it becomes less attractive the higher it goes and you want to sell it. These are inconsistent. And likewise, on the downside, if a stock is falling, momentum says get out or stay out, and value investing says get excited and buy more. And I try to square these things in a way that works for me, because they're both right somehow, even though it doesn't go together. So when a stock I've bought goes down, I have enough respect for momentum that I'm not going to fight it or buy more. I buy a stock, I find out next week it went down. I don't want to do anything. And that's this tension between momentum and value investing. If I bought it at a 5-to-1 upside to downside and it goes to 6, and it goes to 7, and it goes to 8 upside down, goes to 10 upside to downside, I want to be compelled to buy it. So maybe at 15 upside to downside, or even where it went below my downside. Downside realistic value for the business, not like stock price. Stocks do everything under the sun. But I want to be compelled. So at 15 times or something that's really ridiculous, and I've probably written in my journal several times about if I want to buy this thing now. But at 15 times, then I'll come in, because value investing works and I'm a value investor. This respect for momentum is not absolute. But it gets me not to fight what the stock price is doing. And that's how I deal with this. So don't do anything unless it gets crazy if the market is dropping on you, if your stock is dropping on you. That's how I do it. You might find other ways that are better for you, but this works for me. The other outcome is you buy a stock and it goes up. And there again, I don't want to be in a rush to sell. Because I have some respect for these momentum people. They're out there. They're not completely insane. If it goes up because there's good information, change your valuation. Make sure that your values, upside and downside, remain fresh. You want to always be looking out 3 to 5 years. So it shouldn't be stale numbers. You want to not have a low upside to downside ratio because you haven't updated the thing and the thing grew over the past 3 years. Like that's not a good reason to sell. But if you get it where the stock has gone up and your upside to downside ratio is now 3 or something like that, or 2, and it's not so great and you're not so excited about it, first off, if this was a 25% position for me, and now it should probably be a 10% position, and I should just reduce it, but I don't want to be in a huge rush. But take it down to something appropriate for the new upside to downside and ratio of the company. And then evaluate, would I rather own something else than this? And you can evaluate these two, again, because you're good at relative valuation between two things that you understand. So now it's a source of funds, or you can direct it to something better. But again, I don't want to be in a rush to do it. If the stock price gets to an upside-downside ratio below 1, 0.7, 0.6, something like this, I might just sell it regardless of having something else. I might just sell it for cash. I'll write it in my journal. I'll write how this could be a disaster in 2 years. But at that point, again, I'm being compelled by the market to do something. Like it's gone up so high, that's when I'll stick to my value investing roots and not hold off because of some respect for momentum. So that's how I try to deal with momentum versus value investing and in the stock market. A, ignore it. B, don't fight momentum. And yeah, C, come back to value investing, but only at a different level than you came in, or at a very high price relative to what you really think it's worth. And the caveat with this with selling is sometimes you will have a truly outstanding business with a really long runway and a management team that you really trust who is building towards that long runway, and then you hold on to it even though you hold your nose because the stock price is so high. But that's rare. Like you need to be comfortable with that because you're in this rarefied air where your downside is still there, way down here. So be careful with that. The last broad piece of advice when it comes to trading is that you want to have some sort of outlet because everybody wants to do something. Warren Buffett has done stupid things because he hadn't had anything good to do for years. He bought Champion International bonds, he bought US Airways bonds right around the same time because he didn't have anything good to do and it frustrated him, and he's the best. Mere mortals like us need to have some outlet for that very same impulse to do something, because you look at things, you turn pages all day long, eventually you do work on something and it doesn't pan out. You will want to do something. Don't do something stupid. So outlets that are useful for me, I like to look at odd lot tender offers. Every once in a while they turn into a great business like credit acceptance. Most of the time it turns into $50 or $100. But it allows me to trade once a month, which is way better than 0 times a month. And it gives me something to do that A, doesn't hurt, and B, prevents me from doing something stupid. Some people are good at merger arbitrage. This gives you something to do on the occasional deal where it might work out, your downside is limited. If you have things like this that you understand, I think it's valuable to do them, not because of the money that you make, but because it distracts you from doing something dumb. Because Buffett does dumb things when he's bored. Like, don't do dumb things just because you're bored. The second thing that you can do, go running, ride your bike, have hobbies that take up your time, fix guitars, like make amps, whatever people do. Have these outlets. It's better to spend time and money on an outlet that is interesting for you and allows you to refresh your mind and get some of your animal spirits out than to do something dumb that will cost you, tens of thousands of dollars. So you can spend lots of money going on a yoga retreat if it helps you think better, and that's money saved if you would have lost a ton of money on the market because you were so bored and freaking out. So that's my last piece of advice is don't look at the market and have an outlet for what to prevent you from buying something in a dumb way. So thank you very much. I really appreciate the opportunity.